Hello, and thanks for joining us for Sustaining Us here on KLCS PBS. I'm David Nazar. When we talk about sustainability, we're not just referring to the environment and social concerns. Economic sustainability is also part of the equation. In this case, how do we succeed financially and environmentally without compromising future generations? A question the banking and financial industries began asking decades ago. Today, many major companies, financial or otherwise, don't just have a CEO, COO, or CFO. They also have a CSO, Chief Sustainability Officer, and a Corporate Office of Sustainability. And part of this has to do with something known as sustainable investing. These days, many Americans are trying to be as environmentally and socially conscious as possible. For some, it's simple things like recycling, not littering, not wasting water or electricity, or helping the homeless. For others, it's a more ambitious approach, like walking or riding a bicycle everywhere when possible, relying solely on renewable energies and environmentally friendly products, and being dedicated to giving back and affecting change. Well, what if the same were true for your money, your financial future? What if you could make good investments while being socially responsible with your green? This is veteran financial advisor Greg Wendt, based in Santa Monica. Wendt has dedicated his career to sustainability. He's been part of the investment management industry for 30 years while also being an environmentalist and a social activist with several of his own nonprofits. Wendt explains sustainable investing.
Responsible investing or sustainable investing is looking at factors beyond just the bottom line, beyond what does a business do to make money, but how does a business function in society? How does a business function to provide for the workers, for the vendors, for the marketplace, for society, for future generations? And over the last 30, 40 years, there's been an increasing number of people who want their money managed this way.
When sustainable investing began nearly a half century ago, this strategy was more commonly known as socially responsible investing. Today, as Wendt explains, sustainable investing has morphed into a financial phenomenon with nearly $12 trillion invested this way here in the US and about $30 trillion globally.
Sustainable investing was created by investors who wanted their money managed to meet their values, to really match what they wanted the world to look like and make money on their portfolio. So people like churches or nonprofit organizations or charities, they were really the beginners of this industry, where they wanted to avoid what were sin stocks or companies that were just not in alignment. Polluters, nuclear weapons, firearms, tobacco. And these investors started looking at portfolios and taking out these companies.
Wendt says sustainable investing is a complicated process, a process that involves investing in almost anything and everything related to sustainability.
We're investing in organic farming, we're investing in homeless improvement, we're investing in housing, we're investing in urban revitalization, and we're making investments that are going to benefit during this current health crisis. So there's all these different kinds of dynamics in the different dimensions of society where investors can participate in prosperity, in the benefit of all people. Today, there are literally thousands of types of investments that can be made that are aligned with these values all over the world, from micro-lending in different third world countries to helping underprivileged in American urban centers to address food deserts, food access, healthcare, education, revitalization, prison reform. There are investments across the spectrum.
Lawrence Henry has dedicated his career to helping underserved populations. Henry is in charge of retail banking and bank operations for Beneficial State Bank, based in Oakland. Beneficial State Bank is what's known as a CDFI, a Community Development Financial Institution. We met Henry at Beneficial's regional office located in East LA.
When you're a bank that's really focusing on sustainable investment and sustainable banking, what you're doing is you're taking a large percentage of your capital, and instead of investing it in a wealthy community, what we do is focusing our capital in these communities and in individuals who haven't had access to that capital in the past, because we know that if we make that capital available to these individuals, we have an opportunity to actually create wealth in communities where they have not previously had that wealth before.
Wealth in Southern California communities like East LA, South LA, Watts, Compton, and El Monte, for example. Minority communities that Henry says were historically disenfranchised and discriminated from the financial process.
The types of loans that we started to do back then, and a significant percentage of the loans that we're doing now are loans that are going towards women and minority-owned businesses that are both operating in these low to moderate income communities, these underserved communities, in order to, again, introduce capital and investment into these communities.
We look at sustainability in three ways: environmental impact, economic impact, and social impact. So when we recruit and train companies in our incubator, we focus on those three things. In addition, we have a venture fund where we invest in the companies, and we look for our companies to have those type of impacts. So for us, when we're looking at how we work with companies, when we look at how we really develop and invest in companies, environmental, social, and governance impact are a full part of the things that we want to do with the companies here.
Taj Ahmad Eldridge is the Senior Investment Director of Los Angeles Cleantech Incubator. LA Cleantech Incubator, located in the Downtown Arts District, gets its financing from the City and County of LA, grants from the State of California, and private donations from major corporations. Eldridge says this collaboration brings people from all different backgrounds and walks of life together to create what he says is an inclusive green economy, an economy to help unlock innovation with companies involved in things like green technology, green energy, sustainable transportation, and sustainable cities. Eldridge says the goal of LA Cleantech Incubator is to create green jobs, zero emissions, 100% clean energy, and improve air quality and social equity. All this, he says, while working with people of disadvantaged communities to help them be the next CEOs, COOs, and CFOs. Eldridge says sustainable investing goes beyond the financial return, and venture capitalists must take a chance on the companies and the communities working towards a better future.
I think we've noticed in this environment, we've been in a situation with this pandemic globally. We realize that just the return means nothing. We have to take care of not only the people that are there, but our environments and our infrastructure and our systems. And so for me personally, an investor, and when I do make investments, I focus not just on racial and gender diversity, but I focus on geographic diversity. I focus on intellectual diversity as well. In our industry, impact or sustainable investment is really a core part of what we do. See, Cleantech is part of our name, which means that we focus on companies that are looking at renewable energy, electrification and transportation, and the circular economy. Each of those things has an aspect of sustainability within them, whether it's a company that's taking wood waste and making that waste into dyes that can color this suit that I have on and these shoes, or is it a company that's focused on electrification of transportation and really having the delivery trucks that's bringing the Amazon departments to your home electrified. So sustainability is within the investments that we make and the companies that we're focusing on. I'll add this too. We're one of the only incubators that allow our companies to essentially buy back their equity. So when companies come into the incubator, we work with them to take a part of their equity as part of our payment to work with them. But we allow them to get part of that back if they themselves focus on environmental impact, economic impact, or social impact. So it's a way to add a bit of value to doing good as well.
Sustainable investing is vital for the public because we all want a better world for future generations, for our children, and for our communities.
And joining me now to discuss this further is Hazel Henderson. Hazel is the CEO of Ethical Markets. She is a real pioneer, a trailblazer for decades in the field of sustainable investing. Hazel was a cabinet-level science advisor to government agencies in Washington, D.C., including the National Sciences Foundation, the National Academy of Engineering, and the Office of Technology Assessment. Thanks for being here, Hazel. You are certainly an expert.
Oh, thanks for having me.
Before we discuss the field report and learn more about sustainable investing, tell me about you, your company, Ethical Markets.
Well, I founded Ethical Markets in 2004 after spending 20 years advising the Calvert Group and helping to develop the screens on companies, in these ESG impact portfolios. And then I realized, my gosh, corporations are kind of puppets of finance. So I better move up the food chain. And I started Ethical Markets really to look at the whole state of the global financial system and how it was driving more and more environmental pollution, which was my first love. Back in the 1960s, I had started Citizens for Clean Air in New York. And of course, now we know that air pollution kills or at least contributes to the death of 9 million people every year.
So I guess I could ask you, are you an environmentalist or you are a financial advisor, or sort of both? Do they morph together?
Both. Definitely both, David. And so after I started Ethical Markets, we developed a publication called the Green Transition Scoreboard, because we decided that the best thing we could do was to track the private investments already going into those green sectors all over the world, which were kind of pushing back against the fossilized sectors of the last century that still had a lot of political power. And we've been following them for 10 years, and the cumulative investments right now are 10.3 trillion already in the pipeline from private investors like me. And so it's kind of unstoppable now. But the politics of the solar age, which is the book I wrote in 1981, after seeing it all up close, I realized that the fossilized interest groups had all the subsidies and all the money, and it was kind of big versus small, and nobody read this book at that time, but right now it's in 800 libraries around the world in 20 languages. And we are winning now. The green economy is finally breaking through.
So you are an environmentalist, a financial person, and a noted author, I should point out. Now, exactly how can people make money from these types of socially responsible investments? Take me through that.
Well, the main reason is the avoidance of risk. You see, the old fossilized companies from the 19th and 20th century have these tremendous pollution and other external costs, which they've been externalizing from their balance sheets, that they now have to pay. And so that's why they are in decline, and why, according to the Financial Times latest report, 6 out of 10 of the ESG kind of green funds are outperforming the old style funds. And Morningstar is saying the same thing. It says that 745 European green funds are still outperforming in the long term the older funds that are not paying attention. And so basically where we are right now is beyond oil. And we've seen oil prices actually go negative. Back in April 2020 was the first time anyone ever saw that. And that's because we're pumping more oil worldwide than the world can possibly use, because most of it went into transportation. And guess what? Electric vehicles are coming on so fast now that the oil demand is going flat. And so these big oil companies now are having to cut their dividends. They've cut their capital investment in their fossil reserves. And of course, the only reason they're in everybody's 401ks is because people relied on the dividends. And once they stop, as they have now, paying good dividends, everybody is realizing the game is over. And so we call these stranded assets. And what's happening now is the older funds who are using the old playbook, they keep on talking about the risk of the transition, because they have not shifted their assets over to the green economy yet. And those of us already in the green economy are saying, hey, you know, their risk is our opportunity.
So Hazel, though, in closing, as you know, the sustainable investing industry, it has been greatly criticized. There have been many financial advisors. Look, they're still insisting you've got to invest in what you've just mentioned, oil and gas, some of these earlier technologies, even I guess Fortune 500 companies as some examples. They claim sustainable investing is, they're saying, foolish. They claim there's no money to be made in things like solar, wind turbines, green energy. These industries took a lot of flack during the Obama administration, as you recall. And many of these companies with sustainable investing, it's sort of just a way to win in the court of public opinion. Is that a fair criticism, a fair critique of your industry?
No. It isn't really, because they had all of the advertising bucks, and all of their disinformation really was that was funding most of the news programs, saying that they were the better investment. But basically, that now is looking pretty hollow, and so we're looking now for local investing, and that's really coming along very strongly in California. You know, I'm an advisor to the Public Banking Institute, and there are a lot of community loan funds people can invest in where they can see where their money is going. There's the Beneficial State Bank, for example, and the Resource Bank, based in San Francisco. And here in Florida, we have green banks. And so this is a historic shift, really. And what we need to do, these stimulus funds that are coming in from the federal level, because we have to remember that this country, the economy is 70% consumer related. And so that's why we have to have stimulus, but it can't all go back to the old cruise ships and the old hotels and airlines. It has to come forward to all of the students who are coming out and needing jobs, and it has to get down to the people on the ground who will spend it and invest in the local economy.
Hazel, final question. How do we invest in communities more effectively?
Well, I think that there's so many opportunities. There's all of the community development loan funds in every community right there in California. There's all kinds of small businesses. Like, for example, the American Sustainable Business Council has 250,000 small businesses, many of them in California, already committed to the green economy. And so we've got peer-to-peer lending, we've got public banking, we've got infrastructure banking, you've got local banks like the Beneficial State Bank, you've got the Resource Bank. There are so many of these opportunities. And so it's a matter of connecting locally with all of the groups that are really interested in the future rather than the past. And we need to use the stimulus money, which will keep on coming right through 2021, and make sure that it gets down to the people who will actually spend the money into the economy and not have it run right back into Wall Street, for asset bubbles. So we need it to go to students that are coming out with their degrees. All of that local talent at the ground needs to be pulled in and to create create all the new jobs that are going to be available in these new green local sectors.
Thank you so much, Hazel Henderson with Ethical Markets. Thanks for being here.
My pleasure.
And now from sustainable investing to sustainable housing. Low-income residents of U.S. urban cities are struggling more than ever these days to find affordable housing, despite the housing boom throughout America. Many minorities or people who just earn less money living in expensive cities, say for example like LA or New York, struggle the most. However, even the Midwest, once a housing haven for people fleeing city life for a more affordable life, is not immune to this housing crisis. PBS station KCPT in Kansas City has our story.
In American society today, we have gone from decades ago segregating people by race to today segregating people by income. We've ripped this country apart by incomes, and it's the real estate industry that did that.
We have spent hundreds of millions of dollars downtown, probably in excess of $1 billion, just to get this buzz that we have now. We've done all of this to try to create the opportunity, the moment that we have now. And unfortunately for us, I'm not sure that we right now at least have a policy answer for how that moment can involve poor persons as part of it, or disadvantaged folks as part of it. Because you have a lot of working class families, black and white and Latino, et cetera, that are saying, well, yeah, we just can't afford to live in the city the same way now. It's not just families, it's single folks too. How does a city that's growing in other areas help support the areas that aren't? And it's not that you can just ignore them.
The further you get downtown, the more expensive it's gonna be. I was looking for low-income apartments, and everyone that I called, they all said that they were full, they didn't have any spots available. I was working full-time and still not able to afford the place that I was in, and it was a studio apartment, only something that just me and my daughter lived in. Every apartment I went to or knew about or, put in an application for, I got denied from all of them because I didn't make 3 times the rent.
We'll probably actually lose some of our lower income population. It's going to move to suburban communities. Some suburban communities that have more affordable housing, maybe have schools that are close to said housing.
And it's not good for the worker who's out there traveling longer distances to get to and from work.
I had to walk down to the bus stop, then I would go to work that shift. Then I would actually have to get dressed in the bathroom to make it to my next job in time.
To the employer, what it means is, yes, less access to a socioeconomically diverse workforce, fundamentally less access to workers, higher labor costs, and, at some point that has an effect on your bottom line. And so you see this strain on everyone. And then you have a city that is slowly decaying, kind of from the inside out.
People should be able to find stability, especially if they're working. And I was working 2 jobs full-time. Said I had to send my own daughter away from me so she wouldn't have to bounce around from place to place with me. I'm working so much and I'm missing my child grow up. It was a very, very hard time for me. I'm sorry. There's no way I should work all day and still not be able to afford a studio apartment. Studio apartments are cheap. It shouldn't cost this much.
Let's take a half step back and kind of look at a definition of affordable housing. It's 50 and 60% of what they call HUD-defined Jackson County, Missouri, median income. 30% of that median income can be spent on housing. Anything above that is not affordable. And that's where we use the LIHTC, low-income housing tax credits, and those come from the state as well as the federal government.
You do this LIHTC project, you get all these tax benefits, that allows you to do the project, you create affordable rents.
It's something that is used to fill that financial gap so that I can house that low-income person in a quality development.
But the protection of that is a 15-year period. What's happening in Kansas City right now is virtually all of the cool downtown high-rises, man, in the core of downtown and in the city market and around, they all were done in about that same 15-year period, and now they're all rolling out of LIHTC.
The greatest threat we have right now to being able to add to the affordable housing inventory is the state of Missouri's ill-conceived policy of no longer allocating for low-income housing tax credits. So the state is taking away the very tool that has let us have 2,100 of those 6,000 affordable units be rent restricted. It is being taken away from us.
There's not really a mechanism to re-LIHTC them, so they get sold on the open market. Okay, here's all these apartments. 500, 600, 700, 800. Well, now all those same apartments are gonna go 700, 800, 900, 1,400.
Developers are going to do what's profitable for them, what's easy for them, and unless there's an agreement, unless they're forced to do that, they're going to roll it into market rate because they can, and with total disregard for the people that are living there.
These are housing for people that have a job, that live in the city, that do real stuff, that are like mine and your friend at the restaurant, at the auto garage, at the places we go do stuff.
It's not going to get built on its own because the private sector does not build affordable housing.
We won't allow low-income housing tax credits, keep a property available for a certain set of people. And then they're moving somewhere else, they're losing a job, and you continue to create this trend in society of folks that don't have the opportunity to make it.
We, as a community, the city, the civic community, philanthropic business, back in 2000, commissioned a framework, a strategic master plan for downtown. It looked at housing mix, it looked at where should we be doing housing back then because we were kind of a starter housing market. The plan that we worked, in some ways as a community, we were so successful in implementing it, it's kind of done. And now we're a very different looking place than we were in 2000, 2002. We need a strategic master plan 2.0.
We need income restricted units for those individuals who, are just getting, back into having their own place. We need the luxury end as well. We need to be able to attract those empty nesters or those CEOs who would like to live, hopefully, where they have their company and their employees. If a developer comes to the city and wants to use incentives for a project, there should definitely be a percentage of those units within the project that are set aside for workforce or affordable housing.
I really believe we need to get working as quickly and as effectively as a community as possible to develop a comprehensive approach to affordable housing retention as well as expansion. Another component of an affordable housing strategy would be talking to those property owners today. How do we programmatically address their needs that help them make the decision, yes, I'm going to keep this in the affordable inventory? And right now, no one's talking to them.
If something isn't done, we'll lose our affordable housing. It'll be in very minor pockets. And where are all these people supposed to go?
I've looked everywhere. I've looked in the hundreds, the 80s, 90s, 70s, 60s. I've looked everywhere.
You're going to have movement that's based only upon where people think they can find opportunities. And ultimately, if they're moving away from the city, moving away from our suburbs for opportunities, they're gonna eventually move away from Kansas City, move away from Missouri, move away from Kansas, and we'll be the weaker for it.
Thanks, PBS station KCPT in Kansas City, for that report. For more information about our program, just click on klcs.org and then click Contact us to send us your questions and comments or story ideas so we can hear from you. Thank you so much for joining us for this edition of Sustaining Us here on KLCS PBS. I'm David Nazar.